Again, so what we just talked about there, about more people cutting back and not spending that money into the economy, you're already seeing the effects of that happen on delinquencies. So why is it then that the banks aren't preparing for that? And that access to credit, that door is closing, and they've already ramped up their exposure to it, trying to save this sector. So it is totally on a lifeline here, and the entire Canadian financial system rests on the back of this. Little do people understand, because TD Bank is warning of an economic implosion without actually saying it or even preparing for it, which is just absolutely hilarious. So let's get into it. Many homeowners plan to rein in spending as mortgage payments rise upon renewal. This is coming from TD. So what essentially does that mean? That means the economy shrinks as a whole, because obviously if more people are reining in spending, it's not a good thing for the economy. So let's see what they say here. So nearly half of homeowners facing a mortgage renewal in the next year expect their monthly payments to go up, with many anticipating having to adjust their budget to keep up with the higher cost, a survey published this Thursday shows. A TD Bank Group survey conducted between April 10th and 18th said 45% of homeowners facing a mortgage renewal are expecting their monthly payment to rise. But this is the really interesting part. Affordability remains a concern for many homeowners. At least 57% of the survey respondents say they expect the renewal to impact their living situation, and 73% of those say that they'll need to cut back on spending. So that is a huge number of people who are saying, yeah, we're going to start cutting back. We're not going to be spending as much into the economy. And that translates into even less jobs. It is no wonder that you are seeing more and more businesses that are going bankrupt. And yeah, we have to look at Alberta figures for this, because Ontario doesn't publish any decent charts. It's just insane. But this is actually data for Ontario corporate bankruptcies. And I want to show you this because, yeah, there was a spike here in 2024, but it's on the rise again. And still, historically here, you are at 2011, 2012 levels, those post-GFC levels where businesses were being starved of credit, even though the Canadian economy wasn't affected as badly as the US economy. It still had effects on credit. It's just there wasn't as much credit that had been lent out at that point. But boy, has that completely flipped since then. It's just totally different situation right now. The situation right now is disastrous, and that is putting it mildly. So a Royal LePage report published in February estimated 1.2 million mortgages are up for renewal this year. Nearly a quarter of 890 homeowners surveyed said that they will be adjusting their overall financial approach. The survey found 43% of those will be putting renovations on pause, while 29% plan on either downsizing or moving to a more affordable home. And you've just got to remember, guys, who is going to buy? Who's going to be the buyer if all these people are saying, oh yeah, we're just going to downsize and move to a more affordable home? Well, if everybody's doing that, how are you going to do that one? So it's just not going to happen. It's just totally ridiculous what people are relying on here, and they don't even realize it. And again, it's just reducing spending, cutting back on renovations. That means more small businesses will be laying people off, because the Canadian housing market is the Canadian economy. That's the reality of how bad it is in Canada. And that is a TD and a Royal LePage report. So, you know, they are definitely going to sugarcoat things, let's face it. And then Canadian businesses showing signs of strain not seen since 2009. Delinquencies are rising and credit demand is slowing, says Equifax report. This was the recent report a couple of weeks ago that came out, and they pointed this out. So Equifax's Canada's business credit report shows delinquencies are rising for businesses across the country, with the rate in some sectors reaching levels not seen since the financial crisis in 2009. More than 309,000 businesses, or 11% of credit active businesses in Canada, missed at least one payment in the first quarter, an almost 15% increase from the year before, said Equifax. Some sectors are showing more strain than others, particularly those dependent on consumer spending. Again, so what we just just talked about there, about more people cutting back and not spending that money into the economy, you're already seeing the effects of that happen on delinquencies. So why is it then that the banks aren't preparing for that? In fact, let's go to this real quick. I want to show you this because I put it into Warren AI and I said, if TD Bank knew that Canada was heading into a bad recession, does its loan loss provisions go far enough? And basically, it even talks about CRE exposure, which we're going to get onto in a minute. And it says it's the elephant in the vault. TD has deliberately reduced its office property exposure, but its reserves for the segment have still been boosted. In past recessions, banks underestimated just how quickly defaults could cascade. Think of it like sandbagging a riverbank before a storm, only to see the water rise higher. And again, this is the loan loss provisions and the chart there. But again, it points out here that TD's provisions for loan losses jumped sharply, but so did its total loan book. Gross loans now sit at an eye-watering nearly $1 trillion in loans. And bear in mind, I'm not just picking out TD and saying it's the worst bank here. It's all the Canadian banks that are on the same page here. In fact, TD is way better than BMO, for example. And I do not dislike TD. I think they have the best customer service of the big oligarch banks in Canada. Just a modest spike in unemployment could trigger a wave of defaults. The bank's leadership claims that its reserve methodology is thorough, but as any market veteran knows, stress tests are only as good as their assumptions. And that's really the point here. They are assuming that things aren't going to go that bad. And the bottom line, bracing, not bulletproof. TD Bank is sandbagging for a flood, not a tsunami. Its loan loss provisions are strong relative to recent years and peer benchmarks, but no reserve is ever enough if the economy truly unravels. The next recession will test how watertight those risk controls really are. And that's really the point here. You know, what is happening now is really going to strain and test the banking system as more and more people and more businesses are missing payments, when we know the debt to GDP of the private sector in Canada is eye-watering. It's even worse than the household sector. And you've got 309,000 businesses that miss payments. I mean, that is an astronomical figure. And then Economic Woes put this: hardly anybody is talking about how Canadian banks have tightened up lending hard. We've been talking about it on this channel for months and months and months. But yo, don't worry, the Canadian house prices have bottomed out. Meanwhile, houses are being delisted again and again all over the place. But I want to show you this because I think really this is part of why the Canadian banks are reining in their credit right now. And it comes from Ben here on X, and he puts wild chart here. Canadian banks have dramatically ramped up exposure to builders and developers over the past year. Chartered bank total lending to builders and developers, and you can see it's absolutely skyrocketing. And believe it or not, this actually is CRE lending. It's commercial real estate lending because it's not for the end user. That's what actually the developer is selling to people like you or people in the housing market. And what you've got to admit is, why would you be increasing exposure in a time like this? And I can tell you, I mean, it's just a fact really that a lot of these developers would have already gone bust if it wasn't for their access to credit. And that access to credit, that door is closing, and they've already ramped up their exposure to it, trying to save this sector. So it is totally on a lifeline here, and the entire Canadian financial system rests on the back of this. Little do people understand, because people really don't understand how little the loan loss provisions are in Canada. If you compare them to a bank in another country, like in the US, it just shows how dramatically different the reserves are and how low they really are. And that is something that people should be concerned about. I'm not saying banks are going to go bust here. I don't think that would happen in Canada, because the ramifications for the financial system, if there was a bail-in or something like that happen, would be ridiculous. I mean, you've already seeing foreign capital flight and people just wanting to get the the country. So I don't think that's going to happen. They would just print money in order to save any bank or financial institution to safeguard the system. At least that's what they would call it. And then Canadian real estate prices rose 7x faster than wages since 1981. And this is really why this happened, guys. Canadian wage growth has been modest to say the least. The median real average wage for full-time jobs, 30 hours a week, grew 24% between 1981 and 2024. So this is adjusted for the CPI, and it comes in at just over 0.5% of wage growth per year. I mean, it's just absolutely ridiculous. But get this, if you adjust this to a real inflation figure, even slightly more realistic than the CPI, then it goes negative, because I've done it on the charts that I have, and they don't go as far back as this, but they show just how bad it's been since around the late 90s, and that wages have just been negative apart from 2 times, which was in 2021 and also back in 2008. And even then it was negligible, like less than 1%. So it's showing you just how bad it is. And it's really the growth of this bubble started around 2003, 2004, because you can see what happened here, and it lines up just fantastic with the other chart. This is when mortgage debt absolutely skyrocketed, and you can clearly see it's trending up, and then boom, it just skyrockets. And if I go back to this chart here, you can basically see that the median home price went with it as well. In around 2003, 2004, the median home price just absolutely skyrockets there as well. And this is the thing, it's so simple to see a bubble when you look at just those 2 charts. I mean, you don't have to be a rocket scientist to work out it was the debt growth that propelled the housing market. It was no growth whatsoever of the economy, no growth of income, nothing like that. And eventually, rubber meets the road, one reason or another, it just happens. The economy implodes, the housing market implodes with it, because people start losing their jobs, and the unraveling is already beginning of that. And you are seeing more and more jobs that are going to be going because of people cutting back on spending, like we talked about in this video. And bankruptcies continue to hit higher here. And you know, if you pull this out again, look how bad it is. You have to go a long ways back in order to find bankruptcies this high. For Canada, in fact, you're going 15 years back, again, to the post-global financial crisis situation when credit was being starved from businesses. And you're seeing the same thing happening right now, but the difference here is massive, because the difference is people are leveraged to the hills and they cannot pay their debts down without new credit, without taking on new credit. So it's going to be absolute disaster. So anyway, if you've enjoyed this video, I'd highly recommend that you check out this video here. And then if you're looking for a VPN and you also want to help out the channel, then you know where to go. Links are in the description. Also, if you want to check out Warrant AI used in this video, link in the description as well. I will see you in the next one. Take care, guys.